At 2:13 in the morning, your phone rings. A woman says her brother has been arrested. The judge has set bail at $100,000. The family does not have $100,000. They have 10. And they want you to get him out. This sounds like a loan business. It is not. You do not hand the jail the missing $90,000 and wait for the defendant to repay you. Instead, you issue a surety bond, a guarantee to the court that the defendant will appear when required. The family pays the regulated premium. An indemnitor may sign an agreement promising to reimburse losses. You may require collateral. Your insurance company provides the power that allows the bond to be written. And if the defendant appears in court, the premium is earned. But if he disappears, the full $100,000 bond can become a claim against the surety system behind your agency. Then, a clock starts. In Florida, notice of forfeiture is sent to the agent and surety company, and the forfeiture generally must be paid or legally discharged within 60 days. So the business has a strange shape. You may collect $10,000 today. You may carry $100,000 of legal exposure tomorrow. And you are making that decision about a person you may have met for less than an hour. Most people see a bail bonds company as a storefront beside a jail. As an owner, you see an underwriting desk, a regulated insurance agency, a 24-hour sales operation, a document control system, a collections business, and a deadline management machine. The visible service is release from custody. The real product is confidence that a stranger will return. Today, we are going to buy one bail bond agency in Florida. The seller will ask $320,000. By the time the purchase, transition, insurer capital, and liquidity reserves are funded, the real equity check will reach $640,000. We will see why you cannot simply invest money and hire someone else to run it. We will follow one bond from the first phone call to final discharge. We will calculate how an agency can write $8 million of bond face amount in a year, collect $800,000 of gross premium, and still leave the owner with only $38,000 of distributable cash in a normal year. Then we will watch what happens when volume falls, and when 3 defendants fail to appear at exactly the wrong time. By the end, we will compare 2 versions of this business: a surety-backed agency using an insurance company, and a professional bail bond agent using personal capital. One model limits the owner's direct capital requirement but shares the economics and creates dependence on an insurer. The other offers more control but turns every bond into a much more direct liquidity problem. The economics of owning a bail bonds company. Suppose bail is set at $50,000. In our Florida model, the state bond premium is $5,000. A customer pays that premium and the defendant is released. $5,000 appears to have entered your company in a single transaction. This is the number that makes the business look extraordinary. But gross premium is not owner profit. First, you are operating through a surety company or managing general agent. Your contract determines how the premium economics are divided, what build-up funds you must post, which bonds require approval, and how losses are allocated between the parties. Second, the agency has to be staffed before the phone rings. A customer cannot wait until normal retail hours while a relative remains in jail. Your intake process, licensed agent availability, payment system, document software, and court knowledge all need to work nights, weekends, and holidays. Third, every bond creates a file that may remain open for months or years. The premium may be earned when release occurs, but the operational obligation continues until the bond is discharged. Addresses change. Phone numbers stop working. Court dates move. Defendants are arrested in other counties. Collateral has to be tracked and eventually returned. A single missed appearance can turn an old file into the most urgent problem in the office. Fourth, Part of the cash may move into a restricted build-up fund. The money is connected to your business, but it is not the same as freely distributable profit. Finally, losses are not evenly distributed. 900 routine bonds can make the business feel predictable. One large unsecured forfeiture can reveal that the apparent margin was only compensation for carrying a low-frequency, high-severity risk. This is the first lesson. The 10% premium is not a 10% return on capital. It is the gross price of a guarantee whose real cost may arrive long after the sale. We need one exact business. We are not buying a national call center. We are not operating immigration bonds or federal bonds. We are not building a television-style bounty hunting company. And we are not funding cash bail entirely with our own balance sheet. We are buying one established, surety-backed bail bond agency serving primarily one large Florida county. The agency has one public office near the county jail and courthouse area, but not on restricted jail or courthouse property. It employs the owner, 2 additional licensed agents, and 1 administrative case coordinator. The office answers calls around the clock, while maintaining the legally required public business hours. The agency writes approximately 1,000 state bonds per year. The average face amount is $8,000. That means it writes approximately $8 million of new bond face amount each year. That is annual production, not the amount necessarily outstanding at one moment. At a 10% premium, that produces $800,000 of gross written premium. The business operates under an insurer appointment and comes with agency systems, telephone numbers, search visibility, customer reviews, relationships with local defense attorneys that must remain non-referral and compliant, a database of existing defendants and indemnitors, and an experienced staff that knows how the county processes release. But the insurer appointment is not assumed to transfer automatically. Preserving or replacing that capacity is one of the buyer's closing conditions. But there is a critical limitation. You cannot treat this like buying a laundromat. In Florida, a person may not own, control, manage, or otherwise hold a pecuniary interest in a bail bond agency unless that individual is licensed, appointed, and has been actively engaged as a bail bond agent for at least the preceding 24 months. So the asset cannot simply be transferred to any buyer with enough money. The buyer has to be qualified. The agency also depends on appointments from a surety company or managing general agent. The insurer provides approved powers of attorney used to execute bonds. If that relationship ends, the agency may keep its phones, office, and website, but lose the capacity that makes those assets valuable. This means you are not buying only a customer list. You are buying a regulated operating position inside a network of courts, insurers, licensed agents, and local procedures. And unlike a normal acquisition, your personal eligibility is part of the asset value. Imagine you discover this agency for sale, and, like the numbers, you have $640,000 available. You understand marketing. You can hire staff. But you have never written a bail bond. In Florida, that creates a problem no purchase agreement can solve. To qualify as a bail bond agent, an applicant must meet multiple requirements, including Florida residency, minimum education, character standards, a 120-hour qualifying classroom course, an approved correspondence course, and a required examination. Then, even after becoming licensed and appointed, the person who wants to own or control the agency must have been actively engaged as a bail bond agent for the preceding 24 months. The agent in charge also carries responsibility for the overall operation of the agency location. This turns the entry barrier into time rather than equipment. You can buy a tow truck in a week. You can lease a storefront in a month. You cannot purchase 2 years of legally required operating history. That matters economically for 3 reasons. First, qualified buyers are limited. A retiring owner cannot market the agency to every private equity buyer or local entrepreneur. Second, the owner is expected to understand the work. The business cannot be safely reduced to a spreadsheet while every judgment is delegated to the lowest cost employee. Third, key person risk is unusually high. If the qualified owner or agent in charge leaves unexpectedly, becomes ineligible, or loses an appointment, the agency does not merely lose a manager, it can lose the legal structure required to operate. This also changes valuation. A company with transferable systems and a broad management team deserves one type of multiple. A company whose license, insurer appointment, and local judgment are concentrated in one person deserves another. The first hidden cost of ownership is therefore not a bond loss. It is the years required to become the kind of person legally allowed to own the business. To understand the money, we need to understand the contract. A bail bond is a form of surety bond. There are three central parties. The principal is the defendant whose appearance is required. The obligee is the court or state receiving the guarantee. The surety is the company guaranteeing performance. A fourth person often becomes economically essential, the indemnitor. This may be a parent, spouse, employer, or friend who pays the premium, pledges collateral, and agrees to reimburse losses and permitted expenses if the defendant breaches the agreement. Your agency acts on behalf of the surety company under an appointment and a power of attorney. For a simple example, assume bail is $20,000. The family contacts your office. You confirm the charge, bond status, jail location, and court information. You identify who will pay the $2,000 premium. You evaluate the defendant and the proposed indemnitor. You decide whether the bond fits your authority and underwriting rules. If necessary, you obtain approval from the managing general agent or insurer. You collect the premium and any required collateral, complete the agreements, provide receipts and notices, and execute the bond. The jail processes release. At that moment, the customer sees the transaction as completed. For you, the long part has just begun. The premium is earned, but the bond remains outstanding until the court terminates the liability. The defendant must appear as required and comply with bond conditions. The agency must maintain records, track status, and respond to changes. If everything works, the case eventually ends or the bond is otherwise discharged. Collateral is returned under the applicable rules. The file closes. If the defendant fails to appear, the bond can be forfeited. Then, the office stops behaving like a sales company and starts behaving like a claims department. That is why the indemnitor is not a paperwork formality. The defendant may have the freedom to leave. The indemnitor gives the agency another person with money, property, reputation, and family influence tied to the appearance obligation. The real credit decision is often not only whether you trust the defendant, it is whether the surrounding network can keep the defendant reachable and can absorb a loss if it cannot. Our agency writes 1,000 state bonds in 1 year. The average face amount is $8,000. Total new bond liability is $8 million. At the Florida state premium rate of 10%, gross premium written is $800,000. That is the top-line number, but the agency does not automatically keep all of it. Our model assumes the surety company and managing general agent collectively retain 15% of gross premium under the agency contract. That is $120,000. The agency retains $680,000 of commission revenue. This 15% split is an assumption, not a Florida statutory rate and not a claim about a named insurer's contract. The critical point is structural. The insurer provides more than a logo. It supplies the surety capacity, approved powers of attorney, claims infrastructure, regulatory capital, and a backstop that allows the agency to write far more bond liability than its own cash could support. In exchange, the agency shares economics, follows underwriting restrictions, and may have to indemnify the insurer for losses under its contract. The premium also has a special characteristic. The agency cannot solve competition by advertising a lower price. Florida prohibits reduced premium rates and misleading discounts. The agent must charge the approved rate rather than negotiate freely for each customer's risk. This creates an unusual market. A careful defendant and a dangerous flight risk may face the same regulated premium percentage. You cannot charge one customer 10% and another 25% because the second customer appears more likely to disappear. You can ask for stronger collateral. You can require a better indemnitor. You can seek special approval, or you can refuse the bond. So the agency does not price risk in the ordinary way. It selects risk. That difference is the center of the entire business. A customer offers $10,000 of cash collateral, or a vehicle, or a certificate of deposit, or an interest in real property. It is tempting to see collateral as extra money controlled by the agency. Legally and economically, that is the wrong view. Collateral is security against performance and reimbursement obligations. Florida requires collateral to be reasonable relative to the bond. It may not be used for the agent's personal benefit or gain and must generally be returned after final termination of liability. Larger amounts of cash collateral are subject to specific remittance and custody requirements involving the insurer. This means collateral creates work without necessarily creating revenue. You have to identify it, value it conservatively, document who provided it, store or perfect the security properly, track it for the life of the bond, prevent unauthorized use, and return it on time when the obligation ends. If a bond is forfeited, conversion of collateral is not simply a matter of taking the asset. Notice, permitted costs, accounting, and return of excess value all matter. A house pledged as security does not become your house because a court date was missed. The structure may involve a lien and legally controlled enforcement, not an instant transfer of ownership. Collateral, therefore, has two functions. First, it protects recovery. If the bond produces a loss, the surety and agent have an identified source of reimbursement. Second, it changes behavior. A defendant may ignore a commercial company. They may be less willing to disappear when a parent has pledged savings or a family member has signed an indemnity agreement. The strongest collateral may be less about liquidation value than influence. But collateral also creates reputational and regulatory risk. A slow, disorganized, or abusive return process can generate complaints, litigation, and discipline long after a profitable bond was closed. The owner must therefore treat collateral as somebody else's property, held under a strict obligation, not as cheap working capital. The storefront may have your name on it. The balance sheet behind the storefront belongs partly to someone else. A limited surety agent operates through an insurer. The insurer may require the agency to contribute part of premium into a build-up fund, often called a BUF account. Florida law requires pledged build-up funds to be held in a trust account and says they may not exceed 40% of premium. The actual contractual percentage may be lower. Our model assumes 10% of gross premium. On $800,000 of gross premium, that means $80,000 is deposited into the restricted build-up fund during the year. This creates an accounting distinction that can easily confuse a new owner. The $80,000 is not the same as payroll expense or rent. It remains an asset connected to the agent or agency under the trust and contract structure. But it is also not freely available to distribute, renovate the office, or pay personal bills. It supports the insurer relationship and can be available against obligations under the contract. This is why the agency can report $118,000 of operating profit before the BUF contribution, but distribute only $38,000 of pre-tax cash in our base year. The missing $80,000 has not vanished. It has become restricted capital. That can be attractive over time if the book performs well and the agency builds equity inside the arrangement. It can also become a trap if the owner has underestimated liquidity needs. A profitable agency can still run short of cash because growth requires more premium deposits, more receivables, more staffing, and more exposure before old bonds have fully terminated. The surety relationship is therefore both the greatest source of leverage and one of the greatest sources of dependency. The insurer allows a $320,000 owner to participate in millions of dollars of annual bond liability. But the insurer can restrict authority, require approval, change contract terms within legal limits, demand additional security, or terminate an appointment under the applicable agreement and law. Your most valuable supplier is also the institution capable of stopping your production line. Two customers call about identical $20,000 bonds. The premium is the same. The exposure is not. The first defendant has lived in the county for 15 years, has stable employment, has close family nearby, and has a parent willing to sign an indemnity agreement and pledge liquid collateral. The second has no stable address, weak local ties, inconsistent information, and nobody willing to accept financial responsibility. The regulated premium does not automatically increase for the second defendant, so the owner has only a few choices. Require stronger security, seek special authority, or decline. This is why the agency's hidden asset is not the office beside the jail. It is the accumulated judgment encoded in its underwriting process. A strong operation asks whether the information is true, whether the indemnitor understands the obligation, whether the collateral can actually be documented, whether the defendant can realistically comply with court requirements, and whether the agency can maintain contact over the expected life of the case. It does not rely on instinct alone. It uses repeatable files, approval limits, documented exceptions, and escalation rules. The owner also has to protect against a dangerous psychological bias. The premium arrives immediately. The loss may arrive months later. That delay makes aggressive agents look brilliant during growth. Every new bond increases revenue today. The poor underwriting decision remains invisible until the defendant misses court, collateral proves defective, or the indemnitor cannot pay. The business can therefore hide deterioration inside a fast-growing book. This is the same problem found in lending and insurance. Revenue is front-loaded, risk is back-loaded, and the person approving the sale may be rewarded before the true cost of the sale is known. Your controls have to reverse that incentive. Agents should not be measured only by gross premium. They should be measured by documentation quality, payment collection, defendant contact, collateral exceptions, forfeiture frequency, recovery cost, and ultimate net loss. The best agent is not the person who says yes most often. It is the person who knows which yes will still look intelligent 2 years later. In many businesses, the owner can generate demand by offering a lower price or paying for referrals. Here, both strategies can create legal problems. Florida prohibits reduced premium advertising. It restricts direct solicitation on jail and courthouse grounds. It prohibits referral payments or things of value to attorneys, law enforcement personnel, jailers, and public officials. It also restricts certain late-night solicitation at the residence of a detainee or family. So, how does an agency compete? Availability, trust, search visibility, clear explanations, reputation, language coverage, payment execution, and speed after the customer initiates contact. The customer is rarely shopping in a calm state. A family member has been arrested. The family may not understand the booking process, the difference between bail and premium, the conditions of release, or how long jail processing will take. A competent agency converts confusion into a sequence. Confirm the bond. Explain the non-refundable premium. Identify the indemnitor. Collect documents. Make the underwriting decision. Execute correctly. Then keep the family informed without promising a release time controlled by the jail. This is where the agency's local knowledge becomes a commercial advantage, not because it has a secret relationship with the courthouse, but because it understands the forms, schedules, portals, contact points, and common delays of one county. A national call center may buy more advertising. A disciplined local agency may convert more calls because it can answer the practical questions immediately. But 24-hour availability has a cost. If licensed agents must personally perform regulated functions, the owner cannot replace the overnight shift with an untrained answering service that negotiates bonds. The service can collect basic information and route a call, but licensed work still requires licensed people operating within the rules. Our model spends $70,000 per year on marketing and $55,000 on the office, phones, software, and answering infrastructure. These costs do not guarantee volume. They only make the agency available when demand appears. And because arrests do not arrive evenly, utilization will always be imperfect. Some nights the phone stays silent. Other nights, 3 families call at once. The business must be staffed for the second night while surviving the first. Now one defendant fails to appear. This is the moment when the bond changes character. Before the missed court date, the file is an outstanding obligation. After forfeiture, it becomes a timed financial claim. Under Florida law, the court declares the bond forfeited after a qualifying failure to appear, and the clerk sends notice to the surety agent and company within 5 days. The forfeiture generally must be paid within 60 days after the notice is sent unless it is discharged under the statute. The countdown is not a suggestion. A notice certificate can establish that it was properly sent even if the agent says it was never received. That means a weak inbox, outdated address, or unmonitored electronic system is not merely bad administration. It can become a bond loss. Within the statutory period, several outcomes are possible. The defendant may be surrendered or arrested and held for return to the county. The defendant may already be in another qualifying institution. A statutory ground for discharge may apply. Or the agency and surety may have to pay the forfeiture and later seek remission if the defendant is recovered under the conditions and time limits set by law. Florida's remission schedule can allow up to 100% within 90 days, then lower maximum percentages over later periods. The word "up to" is essential. Costs, causation, prosecution impact, notice, and procedural compliance all affect the result. This gives the business 2 clocks, the court clock and the economic clock. Every day a defendant remains unresolved can increase recovery expense, reduce the maximum possible remission, and make collateral collection more difficult. But panic is also expensive. The agency must act lawfully, document custody status, and coordinate with licensed professionals and public authorities. It cannot improvise television tactics. Florida does not allow a person simply to call themselves a bounty hunter. Apprehension activity is restricted by licensing and appointment rules. The operational advantage, therefore, comes from information and procedure. Current contact data, fast confirmation of custody, correct holds, certified documents, calendar alerts, and a claims process that starts the hour the notice arrives. A bail agency is often described as a risk business. More precisely, it is a risk business whose outcomes are decided by calendars. A defendant has disappeared. What does that cost? There is no universal number. A person located in the same county within a day is different from someone arrested in another state months later. But the cost categories are predictable. Licensed recovery work, travel, transport, lodging, public agency charges, court filings, attorney review, staff time, and the opportunity cost of senior agents spending days on one old file instead of serving new customers. Some permitted costs may be recoverable from the indemnitor under the contract and law. That does not mean they are collected immediately or in full. An indemnity agreement is only as valuable as the indemnitor's capacity and the agency's. Documentation. This creates another mismatch. The agency may have to pay recovery expenses now. Collateral may be illiquid. The indemnitor may dispute liability. The surety may demand reimbursement under the contract, and remission may arrive only after legal proceedings. So the owner needs a liquidity reserve even when expected ultimate loss is low. Our acquisition capital model includes $75,000 specifically for forfeiture and recovery liquidity. That money is not expected to be consumed every year. It exists because a profitable company can fail if 3 large claims demand cash before recoveries arrive. This is one of the strangest features of the business. The agency's largest economic risk may not be permanent loss. It may be temporary timing. A $100,000 forfeiture that is eventually remitted can still create a crisis if the payment deadline arrives before the reimbursement. The office cannot pay a court with future accounting profit. It needs cash today. And if your $75,000 reserve is not enough, the next question is, who stands behind the bond? That brings us to the company whose appointment and capacity make your storefront useful. The customer sees your name on the office. The court sees a bond backed by a surety company. Roche Surety says it was founded in Florida in 1981 and remains a family-owned specialist serving bail agents. Its public materials emphasize underwriting, agent support, claims, recovery assistance, compliance, and technology. That list explains what the surety layer contributes. It supplies capacity, controls powers of attorney, sets approval limits, receives reports, maintains claims infrastructure, and decides whether your agency remains appointed. In 2011, AM Best cited Roche's capitalization, underwriting, and operating profitability before withdrawing the rating at the company's request. That evidence is historical, not a current rating or current profitability disclosure. The point is not that our local agency will become an insurer. The point is that your apparent leverage is borrowed from a larger balance sheet and control system. You may own the phones, reviews, and customer relationships, but the insurer controls the capacity that converts those assets into bonds. Build-up funds, approval authority, and documentation are therefore not side issues. They are the price of using someone else's balance sheet. And capacity is valuable only when deadlines and claims are managed correctly. A Florida appellate case shows how a defendant can be recovered while the money remains at risk. In May 2024, a defendant connected to $40,000 of appearance bonds failed to appear in Escambia County, Florida. Palmetto Surety was the surety on the bonds. According to a Florida appellate opinion issued in April 2026, the defendant was surrendered about a month later to a neighboring county and held for Escambia County. But the clerk entered judgment after the statutory period, and Palmetto paid the judgment before asking the court to set it aside. The trial court denied the motion. The appellate court reversed, concluding that the statutory conditions for setting aside the judgment had been met. Why does this matter to an owner? Because the defendant was not simply missing forever. The economic dispute turned on custody, a hold for the proper county, statutory timing, payment, and the correct legal procedure. The surety ultimately won the appeal. But winning required litigation after the bond had already become a judgment and had been paid. That means management quality can affect both loss and timing even when the defendant has been found. A careless owner hears, "The defendant is in jail, so the problem is over." A disciplined owner asks, "Which jail? Was the correct hold placed? Has the clerk received the required affirmation? Were return costs paid? Was the forfeiture discharged before judgment? If not, was it paid on time? What motion is available? And which deadline controls the next step?" The case exposes a central truth. Recovery of the person is not automatically recovery of the money. The paperwork has to connect the person to the statutory remedy. In this business, administration is not the back office. Administration is underwriting after the sale. Now we can return to the acquisition and ask what all of that control is actually worth to the owner. Now we can build the year. Our agency writes 1,000 bonds. Average face amount, $8,000. Annual bond face amount written, $8 million. That is production during the year, not the amount necessarily outstanding at one moment. Some older bonds may remain open while newer bonds are discharged. Gross premium at 10%, $800,000. Our assumed surety and managing general agent share is 15% of gross premium, or $120,000. Agency commission revenue is $680,000. Now the expenses. 2 employed licensed agents and 1 administrative coordinator cost $210,000, including payroll taxes and benefits. We assign the working owner a market salary of $90,000. This is important. If the owner works nights, underwrites bonds, manages claims, and supervises the agency, their labor is not free. A business that looks profitable only because the owner works without salary is not producing a true investment return. OS rent, phones, software, electronic records, and answering infrastructure cost $55,000. Marketing costs $70,000. Card processing and uncollected installment amounts cost $28,000. Legal, accounting, licensing, and insurance cost $24,000. Vehicles, travel, monitoring, and recovery operations cost $45,000. And we reserve $40,000 for net forfeiture loss after collateral, indemnity collections, recovery, and remission. Under our explicit model contract, the agency reimburses 100% of those net losses and approved recovery, legal, and claims costs. The surety provides capacity, but it does not make our underwriting mistakes disappear. Total operating expense is $562,000. Subtract that from $680,000 of agency revenue. Operating profit is $118,000. Then the agency contributes $80,000 to its build-up fund under our assumed contract. Pre-tax distributable cash falls to $38,000. The owner also received the modeled $90,000 salary included in expenses. So total current cash compensation to the working owner is $128,000. But only $38,000 is return available after paying the owner a market wage. The $80,000 in the build-up fund increases restricted agency capital, subject to the trust and contract structure. Now include the acquisition. The seller asks $320,000 for the operating agency. The buyer also needs another $320,000 for transaction and transition costs, office transfer, new owner insurer capital, an operating reserve, and forfeiture liquidity. Total owner equity required, $640,000. That means the immediate distributable cash yield is just under 6% before tax. $38,000 divided by $640,000. If you also count the $80,000 increase in restricted build-up funds as economic value, operating profit before that restriction equals about 18.4% of the equity base. But restricted capital cannot pay the owner's mortgage and may be exposed to contractual claims. This is why. 3 different people can describe the same agency 3 different ways. One says the owner receives $128,000 of current cash, including salary. Another says the investment distributes $38,000 on $640,000 of equity. A third points to the $80,000 increase in restricted capital. All 3 numbers can be true. They answer different questions. The cleanest interpretation is this. The owner bought a demanding full-time job, a modest cash return, and a restricted capital account that becomes valuable only if losses remain controlled and the insurer relationship survives. $38,000 is what survives in the good year. Now, remove only 1 out of every 5 customers. Maybe local release practices change. Maybe fewer defendants receive monetary bail. Maybe a stronger competitor takes search traffic. Maybe the county's arrest and booking patterns change. The exact cause does not matter to the model. The agency writes 800 bonds instead of 1,000. At the same average face amount, annual bond face amount written falls from $8 million to $6.4 million. Gross premium falls from $800,000 to $640,000. After the same assumed 15% surety share, agency commission revenue is $544,000. Some costs fall. Card fees decline. Some recovery and travel expense declines. Marketing can be reduced slightly, but the office remains open. The licensed staff still has to cover the phone. The agent in charge still exists. Software, compliance, insurance, and core payroll continue. Our stressed operating expense is $520,000. Operating profit falls to $24,000. Then, the build-up fund receives 10% of gross premium under our assumption, $64,000. Distributable cash becomes negative $40,000. The business is not necessarily insolvent. It added $64,000 to restricted buildup. Capital. The owner still received a salary for working, but the company requires an additional equity contribution instead of paying a distribution. This reveals the fixed cost problem. The agency appears asset-light because it owns no factory and carries no large inventory, but licensed availability is its factory. You cannot reduce the night shift by 20% every time call volume declines. You cannot open the office only on days when profitable defendants are arrested. And because the premium percentage is regulated, you cannot raise price to repair the margin. The owner has only 3 levers: take more market share, lower fixed cost without breaking service or compliance, or accept fewer dollars of distributable cash while the book contracts. Return to the base year. Volume is healthy. The agency is on track for $118,000 of operating profit before build-up fund deposits. Then the year's actual loss experience concentrates in 3 larger defendants who fail to appear. These 3 files replace, not supplement, the $40,000 ordinary loss allowance already included in the base budget. The first bond is $50,000. The defendant is located and held within 60 days. The forfeiture is discharged after the required conditions are met, but the agency spends $7,000 on licensed recovery, travel, transport, and administration. Permanent bond loss, 0. Cash cost, $7,000. The second bond is $75,000. The defendant is recovered after approximately 150 days. For the model, assume the court grants 95% remission after statutory conditions and costs are satisfied. The unrecovered 5% of the bond is $3,750. Recovery, legal, and administrative costs total $12,000. Total economic cost, $15,750. This remission result is an assumption. Florida law permits up to specified percentages. It does not guarantee the maximum award. The third bond is $100,000. The defendant is not recovered within the modeled period. The surety ultimately pays the bond as required, and under our modeled contract, the agency must reimburse 100% of the net bond loss plus approved recovery, legal, and claims costs. Only $30,000 is recovered through valid collateral and indemnity. Net permanent bond loss is $70,000. Recovery and legal costs add $15,000. Total economic cost, $85,000. Combine the three files. $7,000, $15,750, $85,000. Total cost, $107,750. These three files are now the year's complete modeled loss experience. They replace the $40,000 ordinary annual allowance already inside operating expense. So the incremental shock above the base budget is $67,750. Operating profit falls from $118,000 to approximately $50,250. After the $80,000 build-up fund deposit, distributable cash becomes negative $29,750. The largest file alone costs $85,000. Compared with the $40,000 ordinary loss allowance already in the base case, its incremental damage is $45,000, more than the entire $38,000 owner distribution. That is how one skip can erase a year of distributable profit. The other two files push the company further into a cash requirement. And the model is still relatively favorable. It assumes $30,000 of collateral recovery on the largest bond. It assumes strong remission on the second. It does not include a dispute with the indemnitor, defective collateral, or a contractual loss charge larger than expected. This is why the agency cannot underwrite only to average loss. It must survive clustered loss. The dangerous scenario is not one problem every quarter. It is three problems before the first reimbursement arrives. And when you buy an existing agency, some of those problems may already be hiding inside the open book. Suppose the owner offers to sell the agency for $320,000. That purchase price is only half of the $640,000 equity check in our model. The rest is the capital required to transfer, stabilize, and protect the operation. What do you inspect? Not just revenue. First, verify licenses, appointments, and ownership eligibility. Is the agency license current? Are the owner and agent in charge qualified? Are every location and appointment correctly recorded? Can you personally satisfy the 24-month ownership requirement? Second, inspect the surety agreement. What premium share does the agency retain? What build-up fund contribution is required? Who owns the account economically? When can funds be released? What authority limits apply by bond size or charge? How are forfeiture losses, legal costs, and collateral recoveries allocated? Can the insurer terminate the appointment after a change of control? Do any seller-funded build-up accounts transfer, remain with the seller, or have to be rebuilt by the buyer? Third, reconstruct the outstanding book. How much total bond liability remains open? How old are the bonds? How much is concentrated in the 10 largest defendants? Which files have weak contact information? Which cases already have failures to appear, warrants, or disputed collateral? A seller can show a profitable income statement while transferring a book containing future claims. Fourth, reconcile cash and trust property. Does every premium receipt match the accounting system? Does every collateral receipt identify where the property is held? Does the physical or financial collateral actually exist? Are build-up funds reconciled to insurer statements? Are customer payment plans collectible or merely recorded as revenue? Fifth, Inspect loss development. Do not ask only how many forfeitures occurred. Ask how many became paid losses. How long recoveries took. How much remission was obtained. How much was recovered from indemnitors. How much was spent on recovery. And whether recent growth has produced claims that have not matured yet. Sixth, understand customer acquisition. How much traffic comes from the seller's personal reputation? How much comes from the phone number, website, and reviews? Are any referral relationships non-compliant? Will search rankings, phone ownership, and brand names transfer? Finally, inspect the calendar system. A company can survive mediocre marketing. It cannot survive missing forfeiture notices, collateral return deadlines, and court documentation. The best due diligence question may be the simplest. Show me every open deadline for every active bond. If the seller cannot do that, you are not buying a book of business. You are buying an unknown number of clocks. Once you know what is hiding in the open book, one final question remains. Whose balance sheet will stand behind the next bond? Florida recognizes two economically different paths. The first is the model we have used, a limited surety agent appointed by an insurer. The insurer provides the surety backing and powers of attorney. The agent markets, underwrites, executes, and services bonds under the appointment. The agency shares premium economics, contributes build-up funds, and accepts contractual obligations to the insurer. The benefit is leverage. Our owner can support $8 million of annual bond writing without depositing $8 million of personal cash at the courthouse. The cost is dependency. The surety controls capacity, contract terms, and authority. The second path is a professional bail bond agent. Florida's compliance guidance says this agent uses personal money, such as U.S. currency, postal money orders, or cashier's checks, as security for bail bonds, and appoints themselves rather than being appointed by an insurance company. The professional agent must meet the general qualifications and file detailed financial information and an approved rating plan. This model removes the surety layer, but it does not remove risk. It moves more of the risk and liquidity directly onto the owner's balance sheet. A professional agent may keep economics otherwise shared with an insurer. In return, every large bond competes for personal capital. Growth becomes much more expensive, concentration becomes more dangerous, and a run of forfeitures can impair the exact funds needed to continue writing. The two businesses, therefore, optimize different constraints. The surety-backed agency is constrained by contract and appointment. The professional agent is constrained by capital. For most owners trying to build volume with several $100,000 rather than several million, the surety-backed model is the realistic entry point. For a heavily capitalized operator with exceptional underwriting discipline, the professional model may offer more control. But control is valuable only when the owner has enough liquidity to survive being wrong. So, should you buy the agency? Only if you understand what the business is not. It is not passive income. Florida's ownership rules make that clear before the first dollar is invested. It is not a simple 10% commission business. The surety share, payroll, marketing, recovery expense, ordinary losses, and restricted buildup capital sit between gross premium and owner cash. It is not a lending business in the ordinary sense. You do not advance the missing 90% as a customer loan. You issue a guarantee backed by an insurer, an indemnity structure, collateral, and the expectation of court appearance. And it is not primarily a recovery business. If your profits depend on chasing people after they disappear, the underwriting has already failed. The strongest agency makes its money before forfeiture. It selects defendants carefully, finds reliable indemnitors, documents collateral, maintains contact, controls court dates, and acts immediately when a file changes. Our model agency writes $8 million of bond face amount in a year and produces $800,000 of gross premium. After the assumed surety share and operating expenses, it earns $118,000 before build-up fund deposits. After adding $80,000 to restricted capital, only $38,000 remains for distribution. The working owner also receives a $90,000 market salary. That can be a respectable working income, but the $38,000 distribution is only a modest cash return on the full $640,000 equity requirement. But it is not effortless wealth. A 20% volume decline creates a $40,000 cash requirement. 3 concentrated skips create another negative distribution year, while the largest modeled file alone is enough to erase the normal distribution after the existing loss allowance is considered. One bad notice process can turn a recoverable file into litigation. And loss of the surety appointment can remove the capacity that makes the entire agency useful. The business fits an owner who is licensed, local, available, and comfortable saying no. Someone who can sell under emotional pressure without exploiting it. Someone who treats paperwork as risk control. Someone who understands that the family standing across the desk is a customer, an indemnitor, and often the strongest influence keeping the defendant connected to court. And someone who can hold enough liquidity to survive a problem before the legal system resolves it. If you want a passive storefront that collects 10% every time a jail door opens, do not buy this business. That business does not exist. What exists is a regulated insurance agency making thousands of small judgments about human behavior. The premium is fixed. The deadline is fixed. The loss is not. Because when you own a bail bonds company, the question is never only whether someone can get out tonight. The question is whether you are willing to guarantee that they will come back.